With all of this earnings, though, and economic news that's coming out, we're very glad to have with us again Mohamed El-Erian. He's the CEO and co-chief investment officer of Pimco, the $1.7 trillion fund manager. Mohamed, always great to have you in the loop. And what a day today with the GDP numbers that have come in softer than expected. What's your reaction to that?
A couple of reactions, Betty, and thank you for having me on. First, the level, as you say, is softer at 2.2 versus what was expected 2.5. But I think more importantly is the composition. Now, what surprised on the upside was personal consumption. But unfortunately, that came on the back of this saving. So if you look at what happened to the personal savings rate, it's gone down from 4.5% to 3.9%. Which raises a question as to how long can we continue as a society to consume by saving less. What we really want to see go up, which is business investment, ended up coming down. So whether you look at the level or the composition, this signals that we are in an economy that unfortunately is having difficulty gaining traction, and the engines are not sustainable engines.
It's interesting, right, Mohamed, because business investment was just saw a gain of 1.4%, but as you say, a very big drop from what we saw in the prior quarter. How do you explain that when you've had some companies in their earnings season so far reporting record profits, or certainly profits that have been well above expectations?
It speaks to something that you just spoke with Dom and others. There's this tug-of-war going on between really well-run companies that have their act together, that have their costs contained, that are benefiting from growth, especially overseas, versus these big macro uncertainties. We have a fiscal cliff in the US, we have Europe, we have geopolitics. So when you put these two things together, there's a certain amount of hesitancy. And there's a certain amount of let's stay on the sideline, and we've started to pick that up on business investment. So I think it has to do with the macro uncertainties conflicting with the micro strength.
So then, given that tug of war, Mohamed, you know, because ultimately what we're watching for is jobs growth. Does that mean that as so long as you see business investment stay down like this or in the lower levels, we're not going to see very much jobs growth then?
We're certainly not going to see enough job growth. I mean, remember, we're still stuck at 8.2% with over 5 million Americans unemployed and a particularly bad unemployment rate among the young. And that is not good news. So we need a very vibrant labor market, and we're not getting that. And it speaks to other things, Betty, that you and I have spoken about, which is the need to reform certain elements. We need labor retooling and retraining. We need education reform. We need public finance reform. So there's a whole set of things that need to be done.
Right.
They're not being done, and therefore the economy is going forward, but going forward much slower than what is needed.
Mohamed, when you say enough jobs growth, what do you mean by that?
So look, we need every month to create about 250 to 300,000 jobs if we are to seriously start reducing unemployment to something that is acceptable from a society's perspective. We're not there yet. In fact, if anything, there are indications, look at the latest claims number, that the labor market is cooling off a little bit and doing so too early. So I think we need to continue to focus on that.
So does that mean that the chances are very unlikely that we will see that type of jobs growth anytime this year?
It is unlikely. And what I worry about most is that we will repeat what we saw in 2010 and 2011, which is we start the year really strongly, and then come the second and third quarter, it slows down, and we lose the momentum that's so important to sustain a really good recovery.
And given that, Mohamed, take what's going on in the macro and put it towards the stock market, have we seen basically the momentum, that rally? Have we seen it for the year?
It's hard to say because you've got these really big uncertainties like Europe out there as well. And that speaks to a fundamental investment theme, Betty. Rather than try and go for the headliner, do the work at the company level. You know, if you talk to our equity portfolio managers, they're really excited about certain companies that share the following characteristics. They have good cash buffers, they have high operating margins, they have low financial leverage,
right,
and they're exposed to growth areas. And that is where you should focus,
okay,
including not just the corporate, but also sovereigns.
Okay, so it's the stock picking. Well, we are back with Mohamed El-Erian, the Pimco CEO and the co-CIO. Mohamed, I just want to read for you something that Bill Gross tweeted, because you know he's very active, right, on Twitter. And this is what he tweeted earlier this week in reaction to Apple. He said, quote, if our stock market and economy is so dominated by one stock and its daily fluctuations, be careful. Do you agree with that?
Yeah, Betty, it speaks to something that we've been looking at for a number of years now, which is how to formulate good indices. So whether it's on the equity side and particularly on the debt side at a time when sovereign debt is exploding, this notion of market capitalization, where the bigger you get, the bigger your weight in the index, the more people have to allocate to you. When you get beyond a certain point, that becomes counterproductive. So we've been looking at indices, and in fact, we've launched a whole set of indices that say, let's look at a different way to weight countries. And we do it by GDP, which we think captures better the potential of an investment as opposed to market capitalization, which beyond a certain point can become distortive.
Right, but and it can also, but getting back to Apple, and I understand what you're saying about just looking at market cap, but Apple itself has become such a dominant theme in the stock market. How unhealthy is it when investors start saying, look, where Apple goes is where the stock market goes?
Yeah, I mean, that's the mindset today. It's going to change, but let's also remember that Apple has this combination that very few companies achieve, which is to be viewed as innovation and to sell enchantment. And these two things are really hard to combine, and Apple has managed to do so.
All right, and by the way, Josh and Dom are standing by here as well, and I know you've got a question for him.
Yeah, Mohamed.
Do they have the sweaters on? Because I really like that walk down the aisle.
I can't afford those sweaters, Dr. El-Erian. I don't know.
Let me ask you.
We'll send you one, by the
yes.
way.
Mohamed, there's been some concern, sell in May and go away, that worked pretty well the last couple of years. There's been some concern that 2012 we could see a repeat. What's your near to intermediate term outlook for the U.S. stock market?
I think cautious. We've had a really nice rally in the first quarter. We have basically been paid forward. We've been paid on the assumption that we can sustain this recovery and on the assumption that tranquility can be maintained in Europe. Both these assumptions are under question. So I would be careful, and I would go back to what I said earlier, which is rather than focus on markets as a whole, be very differentiated, because there are certain stocks, sovereigns, that are going to do well, and others that simply don't have enough cushion to navigate a more bumpy road.
Dr. El-Erian, one of the things that we've talked about often is this idea that central banks around the world are pretty much not going to let the markets really stumble that much. Liquidity will be in the system here, so we may not see the big falls, sharp ones that we saw in the past, though. How long could it take a market to really, say, go down here if we don't expect the volatility as much in the short term? This is still could be really a secular downtrend kind of theme over the next, say, year or two, especially with GDP in the U.S. at 2.2%, right?
Yeah, so the role of policymakers is huge, absolutely huge, both in terms of sustaining valuations that are above fundamentals and in also sustaining correlations that are historically strange. So policymakers are playing a really important role. Now, when you look at policymaking, you've got to distinguish between three things: the willingness to do something, the ability to do something, and effectiveness. I don't think there's any question that policymakers are willing to do whatever it takes to maintain market valuations high in order to hand off to a healthy economy. And I think that is what the market believes. The more difficult question is effectiveness.
But Mohamed, quickly though, do you think that the Fed will do something to boost the markets if the economy deteriorates?
Yes, I do. I don't think there's an immediate need now, but I think if we continue with this weakening trend, then the Fed will once again come back in to try and sustain this market and try to sustain this economy.
Joining us now is Michael Gurka. He's the managing director of Chicago-based Spectrum Asset Management, also Pimco's Mohamed El-Erian back with us as well. But Michael, let me start with you. Look, the markets seem like they're taking the GDP numbers in stride. Why is that?
Well, the world's greatest barometer of economic news, being the S&P 500, really is somewhat poised technically to continue its ascent here. And I think a lot of it is actually based on what is coming up a little bit later, being the confidence number for Michigan. You know what? Those are very correlated to the way energy prices are. And right now, since we're not trading above 105 too heavy, I think that confidence looks as though it might be very buoyant here. But again, I think the equity markets really are very, very optimistic at this point, considering where we're at this point in the year.
Well, Mohamed, Michael has a point here. There's a little bit of optimism, but again, let's talk about the realistic approach here. If there are signs that the economic indicators are slowing down, job growth maybe not as robust, the GDP coming in not as robust anymore, maybe no fears of a market crash, but isn't there a case to be made that the market should be at least moving down slightly here, Mohamed?
Look, you can make either case. On the macro, you can make the case that the market is too high. On the micro, which is the strength of the company, you can make the case that this market can go further. I think it's also interesting that this market has absorbed a two-notch downgrade for Spain, which a few months ago this market would not have been able to.
Yeah,
so
that's true.
we are at this very delicate balance, and let's keep a focus on it because it is a very delicate balance.
Well, Mohamed, speaking of Spain, do you think it's too big to bail?
Look, that is a really interesting question. You certainly don't want to be in a position where you have to both fund the government and the capitalization of the banking system, because these two things can be really large. So if you're asking me, can we fund both these things, I would tell you, let's not go there. If you're saying, can the outside world
But that means no, Mohamed. That means no, right?
Yeah, it means that everything has to be done by Spain and by Europe to make sure that Spain can finance itself, that Spain can retain access to the markets.
Right, but the way they're doing that is with 25% austerity cuts. Is that realistic with what Spain and the rest of Europe is going through?
And that's the big question. You know, we're looking at a 24% unemployment rate, and S&P just told us that they expect the economy to contract by 1.5%, and they expect debt to GDP to go up to almost 90% by 2015. So it's not going to be easy, and that's why everybody has to keep an eye on Spain, because it's really important. In addition to, let's not forget what's happening on May 6th, we have a whole host of elections in Europe.
That's right. Michael, just quickly, I mean, Mohamed made a great point about how this market seems to have been able to absorb that Spain news about the downgrade.
Well, again, I think the biggest surprise here is not necessarily the continued strength in equities or even the fact that where energy prices are. For me, at least in the last couple of weeks, the biggest surprise has been clearly seeing the dollar look weaker versus the euro. I mean, most of the traders, let alone forecasters, have anticipated that 130 level might have been breached earlier this month. And look where we're at right now. We're seeing extension in the British pound, even though they've told us about a double dip. Really surprising for me is in the dollar's weakness. I just didn't see that happening.
Dr. El-Erian, 20 seconds here. Are you happy with the Jets draft last night?
I've got my fingers and toes and everything else crossed.
All right, there you go.